Rohr here with an early global view on Friday, the 13th of March, 2015. It's currently 7:35 a.m. We're coming to you a bit later than usual because we decided to wait for the US PPI indication. We're glad we did because after the weak retail sales yesterday meant bad news is good news for the equities along with the govies because of the sense the Fed might raise less quickly. In this case, further weak news has left the S&P back under a bit of pressure. How much weak news can the equities really take? We'll revisit that in a little bit. So we need to ask, what does all this mean to the markets? Now, we're going to be rolling over to the June S&P future contract soon, but due to the spotty trading previous up to this point, as the volume is only now fully shifting into June, we have more history in the March contract. Now, on the early trading, the electronic overnight trading has shifted to the June future. That's off $3. So the equivalent after closing at 2064 in the March contract is that the market would be back down here around 2061. Now that's very interesting because 2062 to 58 was a key lower range. The market broke up yesterday. We didn't bother putting in the up break horizontal dashed line we normally use because that up break was from right around the 2058 Fibonacci retracement level. So this is going to be very important as we go through the day today. Is this a minor dip early in the day in a market that's maintaining upside momentum? And if it is and it manages to start pushing back up, we're also going to see the hourly MACD likely push out through the upper runaway band that it did not manage to get above late yesterday, even though the 30-minute MACD is above its upper runaway band. And we're also going to see a market that's back up into the gap above the gap lower from Tuesday at 2062 that led to the failure of the 2060 to 58 level. Not surprisingly, that led to the test of 2042 to 38, which both on Fibonacci and historic congestion remains the next level. If it does hold and start to push up, it does have resistance back up in the 2075 to 78. Again, that's both historic congestion and a failed recent Fibonacci level since the major all-time high was put in back in December, and the subsequent all-time high was put in after the first of the year up here in the 2017 area shortly before this was made, but then we ran the Fibonacci also from that 2017 area. And what's important about that as well is after Monday's near-term recovery off the Friday post-employment report debacle, Monday's recovery also closed right up at about the high end of 2075 to 78. So there's a gap up here as well. Now, all of these values, as we mentioned, the equivalent is about $7 lower in the June contract. So if you're already looking at June, you can just subtract $7 from any of the areas we mentioned. On current form, therefore, the 2057 key tolerance from the pullback low after the early surge yesterday would be 2050 in the June contract. And that pretty much does it for the short-term view of the S&P 500.